The Senate Special Committee on Aging will come to order. Today, the committee convenes to discuss a critically important issue to the American people, the state of retirement security in our country. We'll include both information about and discussions about for whom this system works well, and then also as well those who the system leaves behind. I think it's true of all of us, no matter where we live or what point of view we have, that we all hope that when we reach old age, we'll be able to enjoy a retirement on our own terms. But the reality is that millions of American families approach retirement with almost nothing saved. Despite working so hard their whole lives, too many seniors are barely able to make ends meet. In 2020, for example, 1/4 of adults who had not yet retired did not have any retirement savings. 1/4 of adults. Many others have managed to save only a fraction of what they will need, and the truth is that our retirement system does very well for some, but it allows millions of Americans to fall through the cracks. Some workers don't have access to retirement plans because their employers don't offer it. For example, in my home state of Pennsylvania, 44% of workers aged 18 to 64 in the private sector work for businesses that do not offer a retirement plan. 44%. In my home state, that amounts to about 2.2 million Pennsylvanians. Others face student loan debt or job changes or caregiving responsibilities that disrupt their ability to save for retirement. In 2019, I was proud to vote for the Secure Act to help close some of these retirement gaps and expand financial security for hardworking Americans. This year, Congress is considering many bipartisan proposals to build upon the Secure Act and expand access to retirement plans, including auto-enrolling workers and making it easier to carry a retirement plan with you when you change jobs. So as we consider these proposals, let us not forget about continuing to both protect and strengthen Social Security, which is the bedrock of our retirement system. Social Security is the most common source of income for most retirees and provides critical protections against poverty for older Americans. We must also consider the foundational issues that prevent people from saving for retirement in the first place. Here's one example from my home region of northeastern Pennsylvania. Sophia Samuel of Wilkes-Barre, Pennsylvania, Luzerne County, who face the difficult choice that millions across our nation are forced to confront. Sophia built a successful career as a professor, but her professional success coincided with a decline in her parents' health. As her parents battled cancer and other chronic health conditions, Sophia made a very tough choice, and that choice was to leave her job. She accepted work with a home care agency where she would be able to be paid to provide care for her parents. But here's the problem. Despite that act of love by Sophia for her parents, that came with a reduction in pay. Her salary went from $80,000 as a professor to just $22,000 as a caregiver. And unfortunately, Sophia is not alone. Millions of Americans face choices like this. Millions of these family caregivers, mostly women, endure financial shocks like these, undermining their ability to save and plan for the future. So that's why legislation like My Better Care, Better Jobs Act is critical. This bill would raise wages for home care workers while allowing them to save more for retirement. It also helped family caregivers like Sophia. It would give them options that they don't have right now, so they don't have to leave their jobs, and it would also allow them, of course, to continue to contribute to their retirement plans. Among other policies Democrats are working on, This policy would expand support for family caregivers as part of the Build Back Better budget, and we're working to help at the same time, in a larger sense, help American families build economic security in their working life and into retirement. So I look forward to our witnesses' testimony today and the wisdom that they bring to us, the ideas they're sharing. And with that, I would yield to the ranking member, Senator Scott.
Thank you, Mr. Chairman, and I appreciate you holding a hearing on such a very important topic today. Seniors all across the country will benefit from hearing what we're having to say today and hearing from our witnesses, but more importantly, or at least not more importantly, but equally as important, folks who are in their 30s and 40s should benefit from the conversation we have about the importance of retirement. Having spent 25 years in the insurance and financial services industry, one of the things I realize is that we don't talk often enough about the importance of retirement security and how we achieve retirement security. For so many of our seniors today, retirement security, when you're working paycheck to paycheck, seems to be outside of your grasp. It seems to be a little too far when you have a little too little money left at the end of the month. One of the reasons why I co-sponsored a resolution designating October as National Retirement Security Month is because I want to make sure that we continue to emphasize the importance of focusing on retirement security for our seniors and, frankly, for those in their 40s and 50s. Over the course of the past decade, the population of those 65 years and older has grown by more than 1/3 in just 10 years, a trend that we expect will continue. Today, I am releasing a report entitled The American Dream in Our Golden Years, Improving Retirement Security and Building Independence. The report reviews the current trends and gaps in retirement savings, recent reforms, and proposals to strengthen America's retirement system. One important issue outlined in this report is retirement account leakage and auto portability. Roughly 15 million retirement plan participants change jobs every year. When my grandparents and my mom, when they started working, they literally stayed at the same employer for a very long time. My mother's been with her employer for 45 plus years. That trend is something in the rearview mirror. The average person today will work for between 7 and 11 employers. That means that every time you change jobs, you have a chance to withdraw your money from your 401k, and that's what we mean by leakage. About $92 billion leaked out. The importance of that is that when you have that kind of leakage on an annual basis, that means fewer dollars will be there when you really need it the most, when the future you wants to retire and live comfortably. Too much of your resources may have leaked out along the way. We want to today talk about ways to address that really important issue. One of the witnesses that we will hear from today is Spencer Williams at Retirement Clearinghouse on how auto portability is slowing retirement account leakage, making it easier for folks to live more comfortably while retired. I look forward to hearing from Mr. Williams and working with my colleagues in Congress so we can increase retirement security for all Americans. My report also outlines other obstacles, like helping small businesses provide retirement accounts. In South Carolina, approximately 400,000 full-time employees and somewhere over 200,000 part-time employees did not have access to an employer-provided retirement plan in 2019. Helping small businesses launch retirement plans is crucial to boosting employee savings and closing the gap of how much money you need when you're retired and how much money you can save along the way. Research shows that workers who earn between $30,000 and $50,000 are 12 times more likely to save through employer-provided plans than on their own. I, too, sponsored the SECURE Act, which included pooled employer plans to help small businesses launch retirement plans. In July of 2021, John Icofano, owner of Icofano's Catering in Mount Pleasant, launched a PEP, Pooled Employer Plan, that allows him, for the first time, to provide a retirement plan to his employees. Another key area my report examines is the complicated and confusing rules seniors face when deciding when to collect Social Security. This rule, known as the Retirement Earnings Test, or RET, confuses retirees and disincentivizes work because it is viewed as a tax. That's why today I introduce the Senior Citizens Freedom to Work Act of 2021 to remove the RET and simplify the decision-making process for seniors. I look forward to discussing these reforms and more so we can ensure that all Americans have the tools necessary to retire with dignity and independence during their golden years. Thank you, Mr. Chairman.
Thank you, Ranking Member Scott. As many of you know, we have senators pretty busy on a Thursday morning, so people will be in and out, but I want to acknowledge the presence of Senator Collins, our former chair, Senator Rosen as well, and Senator Rick Scott. Let me move now to our witnesses and by way of introductions. Our first witness is Dr. John Scott. Dr. Scott directs the Retirement Savings Project for Pew Charitable Trust. He's also an adjunct associate research professor at the University of North Carolina at Chapel Hill. I want to acknowledge Dr. Scott's own Pennsylvania connection. He received a law degree from Penn State University. Our second witness is Shai Akabis, and Shai Akabis is the Director of Economic Policy for the Bipartisan Policy Center, and for the past several years, he has also steered the Center's Commission on Retirement Security and Personal Savings. Mr. Akabis has conducted research on a variety of economic issues, including on the issues of retirement coverage and financial security. Witness number 3 is Dr. Nari Ree. Dr. Ree is the Director of the Retirement Security Program at the University of California, Berkeley Center for Labor Research and Education. She's written on a wide range of issues, including issues related to retirement security and pensions, including on the subject of gaps in retirement savings based upon gender, race, and ethnicity. I'll now turn to Ranking Member Scott to introduce our fourth witness.
Thank you, Mr. Chairman. It is my pleasure to introduce today Spencer Williams. Spencer lives in Greenville, South Carolina, and is the founder, president, and CEO of the Retirement Clearinghouse. He is an entrepreneur, leader, and a family man. I am proud of his work and the company he has built. Spencer's company has helped more than 1.5 million Americans retain and consolidate over $24 billion in assets for their retirement. Spencer Williams earned his bachelor's degree in English from the United States Naval Academy and his MBA from the University of Pittsburgh. His testimony today is about the important issue of preventing leakage, financial leakage, in our retirement system. Mr. Williams will also talk about the important regulations we work together on to allow for retirement accounts auto portability and what Congress can do to ensure this reform is codified into law. Spencer also works just as hard at home in Greenville, South Carolina, where he is the father of 13 children. I was going to say a 13-year-old, but there are 13 children. I guess that is truly a baker's dozen. And proud grandfather of 31 grandchildren. Spencer, God bless you. We appreciate your entrepreneurship and hard work to help improve retirement security for millions of Americans. Thank you for being here with us today. We look forward to your testimony.
Thank you, Ranking Member Scott. We'll start with our first witness, Dr. Scott. Dr. Scott, you may begin.
Thank you, Chairman Casey, Ranking Member Scott, and members of the Aging Committee for this hearing and the opportunity to testify. The Pew Charitable Trust is an independent, nonpartisan, nonprofit organization that applies a rigorous analytical approach to improving public policy. My oral comments will briefly touch on a few points from my written statement. At least 1/3 of private sector workers lack access to a retirement plan at their jobs, which could lead to reduced living standards in old age. The taxpayers are also affected by low savings. A Pennsylvania study, for example, found that insufficient retirement savings would cost the Commonwealth of Pennsylvania a cumulative $14.3 billion over a 15-year period. In terms of barriers to savings, workers at small businesses have low levels of access to retirement benefits. Only 52% of employees at firms with less than 50 workers have retirement benefits, compared to 85% of those at firms with more than 100 workers. Also, 41% of part-time workers have access to a retirement plan, but even when they do have access, they often don't work enough to qualify. Non-traditional work also reduces retirement plan coverage. Non-traditional workers, also known as gig, contingent, or independent workers, do not have a traditional employer-employee relationship. Only 46% of non-traditional workers that had a job that offered a retirement plan, with only 22% participating in a workplace savings plan. Even so, 77% of these workers would save if given the chance. Apart from employment factors, career disruptions also impact retirement security. For example, Pew's research shows that full-time workers who experienced unemployment in the past 2 years are less likely to have access to an employer-sponsored plan and less likely to participate even if they do, than those who have been consistently employed. Laid off older workers have difficulty finding a new job with benefits and often retire early, and at least 1.7 million more older workers than expected retired due to the pandemic recession. Like unemployment, disability affects access to retirement benefits. In 2020, only 18% of persons with a disability were employed, and across all age and educational groups, persons with disabilities were more likely to be unemployed, work part-time, or work in non-traditional jobs compared to those with no disability. Caring for a loved one also erodes savings. 20% of full-time workers provide regular care for a family member or friend, and they often have to reduce their hours of work or quit their jobs altogether because of caregiving. As a result, 27% of caregivers report that they've stopped saving, and 11% used retirement accounts to pay for other things. Financial shocks also disrupt workers by causing them to take out funds from their retirement savings. Over half of American households have had a large unplanned expense, such as a major medical bill. As the number or the cost of the financial shocks increase, so does the likelihood of retirement account withdrawals. Plan features such as employer contributions can boost participation and account balances, but not all employers can afford to make contributions. Proposals in the current Congress to expand the saver's credit would likely act like an employer contribution. Automatic enrollment is another feature that can jumpstart saving. Vanguard reports that auto enrollment increases participation by 30 percentage points. However, only 36% of small employer plans use this effective tool. Small employers also face obstacles in offering retirement savings options. Small business owners told Pew that starting a retirement plan either is too expensive or that they did not have the administrative capacity to run it. When asked which circumstances would motivate them to begin a plan, the most common responses were a change in their financial situation or government incentives. Finally, just a word about new research on state auto IRA programs. Today, 10 states, including Connecticut, Maine, and just a few days ago, New York, are implementing savings programs for workers without retirement benefits at their job. 400,000 auto-enrolled workers have amassed over $330 million in savings. Employers are embracing these auto IRA programs. Pew found that nearly 3 in 4 employers participating in the Oregon program said they were either satisfied or neutral about the program, and 79% said they have no out-of-pocket costs from participation. This concludes my oral comments. Thank you again for the opportunity to testify, and I would be pleased to answer any questions.
Dr. Scott, thanks for your testimony. Our second witness for today's testimony will be Dr. Acabas, or Mr. Acabas, I'm sorry.
Thank you, Chairman Casey. Chairman Casey, Ranking Member Scott, and distinguished members of the committee. I appreciate you inviting me here to testify today about the current state of retirement security in America and where we can go from here. My name is Shia Cabas, and I'm the Director of Economic Policy at the Bipartisan Policy Center, a nonprofit organization that combines the best ideas from both parties to promote health, security, and opportunity for all Americans. The U.S. retirement system is working well for many people, particularly those with stable employment, sufficient income, and opportunities to save throughout their life. While the structures in place have room for improvement, they result in positive, financially stable outcomes for a majority of households. But the reality is that America is home to a piecemeal retirement system. Congress should focus its efforts on those whom the system does not serve well or at all. My testimony will discuss where current gaps exist and how members of this committee can address them. Let me begin by framing the retirement security challenge we face. A majority of Americans worry about running out of money in retirement, making it the nation's top financial concern. Recent events and trends, from the COVID-19 pandemic and recession to rising healthcare costs to increasing life expectancies, have made building a secure retirement both more important and more difficult. Although all Americans face this challenge, the ability to meet it varies significantly. Workers with low incomes, those without college degrees, people of color, women, and part-time seasonal and temporary workers all disproportionately struggle to save for retirement. Part of the reason why is explained in a recent BPC survey, which found that nearly 90% of households making at least $100,000 report having access to a workplace retirement plan. But the same is true for only half of households making less than $50,000. So even when workers can and want to save, they frequently do not have access to a payroll deduction plan. In 2016, BPC convened a bipartisan commission co-chaired by former Senator Kent Conrad and Jim Lockhart, a senior Bush administration official. The commission spent 2 years studying the state of retirement security in America and made recommendations in 6 key areas, which include 1, improving access to and the design of workplace retirement savings plans; 2, facilitating lifetime income options to reduce the risk of outliving savings; 3, enabling the use of home equity for retirement consumption; 4, improving financial capability among all Americans; 5, strengthening Social Security's finances and modernizing the program; and 6, promoting personal savings for short-term needs and preserving retirement savings for older age. Saving for retirement requires sufficient income. It also requires enough financial security and financial wherewithal to lock some of that income away for years or decades in a long-term account. But workers' ability to do this depends on their overall financial health. While the most common tool Americans use to save for retirement is a plan offered through an employer, only 2/3 of workers in private businesses have access to such a plan. And among those, only 3/4 participate, meaning that only about half of private sector workers are participating in an employer-sponsored retirement plan. Further, if someone lives paycheck to paycheck, has credit card or student loan debt, or lacks job security, we know that person will struggle to save. For these and other reasons, various studies show that millions of Americans are at risk of running out of money in retirement. Public policy needs to address this challenge, not only by looking at the accumulation of retirement assets, but also at the decumulation phase. Instead of handing people a pot of money at retirement and expecting them to figure out how to make it last, we should focus on equipping Americans with the tools to produce sustainable retirement income, such as guidance on systematic withdrawals, options to convert savings into an annuity, access to well-designed home equity products, and helping people determine the optimal age to claim Social Security benefits. There's no one policy prescription that will cure America's retirement security challenge. Different solutions will help different groups of savers. We need an all-of-the-above approach to maximize the reach and effectiveness of our current retirement system. I'll briefly propose a few places to start that have historically had bipartisan support. When you ask businesses why they don't offer retirement plans for employers, the number one reason cited is often cost or administrative burden. The emerging pooled employer plans authorized by the Secure Act should help with this. But there's another part of the equation. Most employers wishing to adopt a retirement plan today must also accept the fiduciary responsibility that goes along with it. For businesses with small or non-existent HR departments, this task is daunting or simply impossible without paying for external support. To help these businesses offer plans while ensuring that their employers are protected, Congress should relax fiduciary obligations for small businesses while transferring that responsibility to other private sector entities and regulators better equipped to handle them. Meanwhile, several states have enacted laws requiring all employers over a certain size to automatically enroll their workers in some form of retirement savings plan. More states are following suit. But workers in states without these requirements are getting left behind, while the emerging patchwork of different requirements in different states is a headache for businesses that operate across state lines. Congress can extend coverage to Americans everywhere and streamline regulations by creating a national minimum coverage standard that preempts the multitude of mandates at the state level. One study found that this approach could increase average retirement savings for the middle-income earners by roughly 50%. On a related front, several pieces of pending bipartisan legislation would build on the success of automatic features and their incorporation into more retirement plans. Congress should also look to extend automatic enrollment into the emergency savings policy space. Boosting short-term savings not only improves household financial resiliency, it also protects against retirement leakage. I expand on these promising solutions in my written testimony and would be glad to discuss them with you further. Finally, I want to note that retirement security has been a standout area of bipartisan cooperation in Congress, in no small part thanks to the leadership of many members of this committee. We at BPC have seen the power that a broad coalition can bring to an issue like retirement security. We launched the Funding Our Future initiative in 2018, and our coalition now unites nearly 60 organizations from the academic, nonprofit, trade association, and corporate sectors. Funding Our Future's 3 goals are to make saving easier for Americans at all ages, help them transform nest eggs into retirement income, and ensure that Social Security is financially stable, both for current and future retirees. I can attest that the coalition's strength and success comes from its bipartisan makeup. We at BPC and Funding Our Future are eager to continue working toward those goals with all of you. Thank you for your time, and I look forward to your questions.
Mr. Cabas, thank you for your testimony. Our next witness will be Dr. Rhee. Dr. Rhee, you may begin.
Thank you. Good morning, Chairman Casey, Ranking Member Scott, and members of the Aging Committee. I'm Nari Rhee, Director of the Retirement Security Program at the UC Berkeley Center for Labor Research and Education. So thank you for this opportunity to speak before you on this very important subject. So as other witnesses have testified, there are large structural gaps in the current employer-sponsored retirement system. So I want to delve a little bit into some key areas where workers are being excluded. In order to have financial security in old age, all workers need to participate in some kind of retirement plan throughout the full arc of their earnings careers. Social Security provides that for a minimum layer of income, but obviously that is not enough for most workers. And the employer-sponsored system falls far short of universal coverage. So about a third to maybe half of workers don't have access to a retirement plan at work. And what's really important to keep in mind is that there are clear patterns in who gets excluded. So the 2 key areas of fallout that I want to highlight include low-wage workers and workers of color, and also the care workforce. So let me talk about the low-wage workforce and workers of color. So there's a direct correlation between whether the opportunity to save in the workplace retirement plan and how high or low your wages are. So 2 out of 5 workers at the bottom 25% of the wage distribution have access to a plan at work, whereas 9 out of 10 workers in the top 25% of the wage distribution do. So if you look at actual participation rates, the disparity by income is even worse. In addition, sectors with the lowest offer rates for retirement plans are where Black and Latino workers tend to be overrepresented. So a couple of key examples. Administrative and waste services, that's where a lot of building services, janitorial services are. Only 38% of workers are offered a plan and only 25% participate. And that's a sector where Black and Latino workers are 40% overrepresented in relation to their overall labor force presence. The hotel and restaurant sector has some of the worst offer rates. It's about 30%, and only 12% of workers in that sector actually participate in a job-based retirement plan. And there, Black and Latino workers are about 60% overrepresented. So the upshot is that only 46% of Black working households and only 37% of Latino working households had anyone in a workplace plan, whether it's a pension or 401k, in 2019, compared to 60% of white working households. So with regard to the care workforce, which consists mostly of women, roughly 1 million home care workers are employed by individual clients and households. And these employers simply don't have the wherewithal to offer a retirement benefit. And another kind of key example is family-based childcare providers. So these are essentially self-employed small business women who operate small childcare operations out of their own homes. And they're a really pivotal component of the childcare infrastructure in the United States. So while IRAs are theoretically available to them and other self-employed people, The reality with regard to IRA usage is that only 14% of self-employed workers contribute to an IRA. Those tend to be high income self-employed people who often have incorporated businesses. And family-based providers often make less than the minimum wage when all expenses are accounted for. And so it's a high bar for them to actually go and sign up for a plan. I've done some technical assistance for a number of care worker and domestic worker organizations that are trying to figure out ways to offer a systematic retirement benefit for their members. And what they're running into is a series of obstacles in the regulatory arena because the entire system was designed around a key relationship between employees and the firm. And so workers who fall outside that model really don't have access to anything like auto enrollment or any way to receive sort of client or employer contributions. And this is a huge barrier. So looking forward, we need a holistic approach to improving the retirement security of low-wage workers and the workers who are currently left out of the system. And so one of the things that I think we need to focus on is that it's both a matter of wage policy and retirement policy. Low-wage workers need more income in order to be able to save, and then they need a systematic means through which to save. Another key area that needs attention is Social Security reform. And with regard to state initiatives, I think what states have done is realize that they need to step into the void because this is going to have major fiscal repercussions down the line to have a lot of workers retire without sufficient means to live on. And I think there actually needs to be federal policy, whether it's like the UK Nest program or the Australian superannuation program that essentially says all workers, no matter what, will be covered, including independent contractors. Thank you. That concludes my comments.
Well, Dr. Rhee, thanks for your testimony. Before turning to our next witness, we're also joined this morning by Senator Warnock. So next we'll turn to Mr. Williams. He'll be our last witness for testimony today. Thank you.
Thank you. Good morning, Chairman Casey, Ranking Member Scott, and members of the committee. Thank you for the opportunity to speak today and for your work to improve the retirement system. It's a particular honor to be here today because I live in the Greenville area, a pastoral paradise in the upstate of South Carolina, and I have the pleasure of being represented by Senator Scott. Retirement Clearinghouse is a fintech company with a mission to dramatically improve the system by preserving retirement savings for the many millions of Americans who change jobs each year. My boss, a fellow by the name of Bob Johnson, is the majority owner of Retirement Clearinghouse and its chairman of the board. You most likely know Bob as the founder of Black Entertainment Television. Bob invested in Retirement Clearinghouse more than a decade ago, and over the years, I have personally witnessed Bob working on the front lines to help minorities and lower income families save for retirement through our work at RCH. Getting people to save is job one. But right after that, the most important improvement we can make is to help those same participants preserve their savings when switching jobs or facing career disruptions. Today, more than 30% of all participants and nearly 50% of minority participants cash out their retirement savings when they change jobs. The savings lost to cash outs adds up to about $100 billion every year, which means that each year, millions of people are cashing out their savings and putting their retirement at risk. That's why we created auto portability. Based on our work with a very large employer, we set out to fix the cash out problem and help preserve savings for America's mobile workforce, in particular for low income workers. Auto portability is a simple concept. It's a technology that allows a person's account to automatically follow them from one employer's plan to the next. The idea is that if we make it easy and automatic, more people will keep their savings in a plan rather than cashing out. Let me give you a real-life example of the impact portability can have on a worker's retirement. In November of 2017, at age 30, Jaime Cervantes was hired by one of our clients, a very large employer in the healthcare services industry, which we would note is a high turnover industry. Jaime lives in El Paso, Texas. Over the course of 3 years and 2 job changes, our services helped Jaime preserve his savings. He made 2 good decisions that have kept his savings intact. And by normal retirement age, his current balance of $5,006 will grow to more than $50,000. There are literally millions of Jaimes that change job each year. And with a modest mix of a nudge and enabling technology, we can help them all. Thanks to support from the ranking member and other members of this committee, including Senator Warren, we were able to work with the Department of Labor on critical regulatory guidance that facilitated auto portability. Now we are working with 2 of the industry's largest providers, Alight Solutions and Vanguard, which will make auto portability available to over 16 million 401k savers. And that's just the beginning. Auto portability will have a tremendous impact on the retirement system. The Employee Benefit Research Institute estimates that auto portability can preserve $1.5 trillion in additional savings over the coming generation. Of that amount, more than $190 billion will be saved by Black workers. We're very appreciative of bipartisan support from members of Congress and their interest in legislation to help encourage system-wide adoption of auto portability. One way to do that would be to provide certainty and stability by codifying into law guidance issued by the Department of Labor. We also think it would be helpful to create modest tax incentives to encourage early adopters of auto portability. These gentle legislative nudges would deliver a tremendous benefit to working families. Thank you for your attention to these issues, your support for auto portability, and for the opportunity to testify today. I'll be pleased to answer any questions.
Mr. Williams, thanks very much for your testimony. I didn't acknowledge when I was making reference to witnesses' biographies that you too have a degree from Pennsylvania institution. Senator Scott noted the MBA from Pitt, so I've got to make sure that's on the record.
Just wanted to make you happy, Mr. Chairman.
Thank you, Ranking Member Scott. Wanted to also note that we have votes today at 11, starting at 11, so we'll be mindful of that. I'll start with the questioning. I'll try to go underneath the time so we can go right to our Republican questioners when we get to that. But Dr. Rhee, I'll start with you and your testimony. I was struck by a lot of the data in your testimony and also the many ways that you highlight those who are left out. One of the highlights on your first page says, and I quote, "The current employer-sponsored retirement savings system leaves out many workers and this disproportionately impacts workers of color," unquote. So that the words leaves out jumped out at me. You also say, and I'm quoting again, "The current retirement system is also not designed to meet the needs of workers in non-standard employment relationships, including those in care work," unquote. We know that women are often doing the most when it comes to caregiving generally and unpaid caregiving in particular. We saw this especially over the last 19 months of this terrible, terrible pandemic as women left the workforce in droves to care for children and aging parents. So, Dr. Rhee, can you explain the effects of caregiving on workers' ability to save for retirement? I don't know if we're having trouble.
Oh, sorry, I forgot to unmute myself. Apologies. So caregiving has tremendous impacts on women in terms of their retirement income security, and it comes at the beginning of their careers with caregiving of children and taking time off of work or reducing your work hours, and also at the tail end of your career when you're taking care of either aging parents or ailing spouses. So the early career interruption from childcare means that women can lose up to $500,000 total in lifetime earnings, cumulative earnings loss, and also Social Security benefit loss and retirement savings loss. And it's important to note that if a woman takes 3 years off to take care of a young child, it's not just those lost years of earnings. There's essentially sort of a penalty that follows them for at least a decade or so. And what happens at the tail end is that if you take time off or start to reduce your work hours, it has impact not only in terms of your savings capacity, but the fact that you're likely to start eating into your retirement savings sooner and also claim Social Security benefits sooner than planned, which actually can have anywhere between a 7 to 12% annual penalty compared to your base benefit when you do that. So I think I will just close there and say they're just phenomenal and compounding cumulative negative impact on women's retirement security from caregiving.
Yeah, and your testimony made that very clear. I wanted to get back to this same issue in a different context of people being left out of the labor force and unable to build retirement savings. Many of them, of course, rely upon Social Security and on supplemental security income, SSI, for their later years. I'm committed, as I know so many are in the Congress, to protecting and strengthening these programs. I introduced a piece of legislation called the SWIFT Act, or Senate Bill 1772, which would strengthen and expand Social Security benefits for widows, widowers, as well as surviving divorced spouses. What are your thoughts, Dr. Rhee, on improving Social Security and SSI as tools to address the gaps in retirement coverage and access?
Yeah, I think I think when we talk about aging issues, we often focus exclusively on the workforce. And we need to remember that when it comes to issues like income security in old age and also long-term care access and funds to have long-term care, then we need to be looking at people who cannot work or have interruptions. And so one of the issues with SSI is that the benefits are so low, they actually haven't kept up at all with the cost of living, and essentially forces people to live well under the poverty line in some cases, and that improving SSI benefits to actually penalize worthless and also to just have a minimum standard of income that's actually sufficient to live on is really important.
Thanks very much, Dr. Rhee. I'll turn to Ranking Member Scott.
I will defer my question time to Senator Collins.
Thank you very much, Senator Scott. That is typically gracious of you. I want to thank both you and the chairman for holding this important hearing. It builds on some work we did in the last Congress on retirement security, but I know, Senator Scott, that it's a real passion of yours and that you bring great expertise to the subject. My first question is for Dr. Scott. And let me start, Dr. Scott, by saying it's good to see you again, even if it's remote. In 2019, when Congress enacted the Secure Act, which many of us co-sponsored, it included a provision that I authored to allow small businesses to band together in a single retirement plan called a pooled employment plan, or PEP. PEPs allows small employers to share the administrative burden of a retirement plan without requiring a connection, a nexus among them. I know the law is very, very new, But Dr. Scott, could you help us better understand how pooled employer plans and other provisions of the Secure Act can improve retirement security for the employees of small businesses?
Well, first of all, let me say, Senator Collins, it's good to see you as well. And I look forward to a time when we can hold these fully in person again. To your question, I think this is actually a pretty exciting provision. As you note, it's very new, and the data isn't quite in yet. I think we're still even waiting for regulations from the executive branch on the implementation of the Secure Act in this area. However, I would say that I was pleasantly surprised by the reaction from the financial services industry. There seems to be a lot of interest in offering pooled employer plan products to small businesses and other employers. So I think we're off to a good start there. I think what is really encouraging about PEPs in particular is that it does reduce the fiduciary liability to a degree for the small business owner. I think a lot of small business owners aren't fully aware of these fiduciary responsibilities when they're thinking about adopting a retirement plan. They're typically focused on the costs of starting a plan and then whether they have the administrative capacity to operate the plan. And so I think it helps a little bit in that regard. It takes some of the shock of that fiduciary liability away. Also, I think it does address the administrative capacity issue in a sense that is much easier to operate in this more streamlined, less customized approach, which the PEPs offer. I think the jury is still a little bit out on the cost component, and that's really up to the providers about how they price these. But I think they're pretty aware that to appeal to small business owners that they have to be competitive. So we're still waiting to see how that pans out as these products mature and are more widely available in the marketplace. But I think we're pleasantly, or I should say, I think we're optimistic going forward about how these PEPs might improve coverage in this area.
Thank you very much. Mr. Williams, I do have a special interest in expanding access to retirement plans among the employees of smaller businesses because they tend not to have access to plans. In April, I introduced the Simple Plan Modernization Act with Senator Warner. Our bill would provide greater flexibility and access to small businesses and their employees seeking to use what's known as the Simple Plan as a retirement savings option. These accounts are available to businesses with 100 or fewer employees. But here's the catch under the current law. The employees of these small businesses are not allowed to contribute as much to their plans as those who work for larger businesses with 401ks. The Simple Plan Modernization Act would address this inequity by increasing the contribution limit for simple plans, allowing small business employees to save more. Mr. Williams, if small business employees were treated comparably to large business employees, would this help improve the savings for the employees of your clients?
Yes, Senator.
Good.
We in the industry use a term harmonization. There's a lot of sort of strange rules and regulations that have built up over the years. I think Dr. Ree referred to a few of those earlier in her testimony. And so any effort to harmonize the rules and optimize savings for all workers equally is a good thing.
Thank you very much. Thank you both.
Great. Thank you, Senator Collins. I know we're awaiting a Democratic senator, but Senator Scott, in the interim, would you want to take your time?
Yes, sir, especially since we're trying to be timely for the vote schedule that we have coming up. Thank you, Mr. Chairman. Mr. Williams, thank you for being here with us today. I'd love to continue the conversation around the issue of leakage. I recognize that in 2015, about $92 billion was lost out of retirement accounts because of leakage. I like to make things practical from sometimes personal experience. I remember in my late 20s, I had a retirement account and decided that I needed the money for something else and took the money out, and I had to pay a 10% penalty and declare it as ordinary income. I did not understand that until I filed my taxes, and then I had a better understanding and appreciation for the definition of leakage. And so the importance of this issue, and if you think about $92 billion in 2015, over a decade, that's close to $1 trillion lost out of Americans' retirement accounts, in addition to paying a 10% penalty on those dollars, as well as declaring that nearly $1 trillion in a decade as ordinary income. That is a devastating impact to those retirement accounts. Can you just maybe give us more light on why people cash out of the retirement accounts and who is most likely to cash out of the retirement accounts? And that may bring us more focus on the importance of the issue of leakage as well as auto portability, making that decision not to cash out easier when you go from job to job.
Thank you, Senator Scott. Yeah, the data is very clear. The workers, plan participants who are most likely to cash out are those with the smallest balances. Okay, there is a very strong impulse to preserve retirement savings. I think Northern Trust did some research a few years ago, and they cited $10,000 as a very important inflection point. Somebody gets $10,000 in their retirement savings, and their mindset changes over the value of those savings. They start to think of it as permanent savings. So we're trying to solve the problem with auto portability down at the low end where, frankly, we need to incubate accounts. We need to make it super easy because every time someone changes a job, they're faced with a decision, okay, particularly at the very low end. And the decision is, I can keep this money intact, and sometimes that involves a lot of paperwork, and it's not easy, and it's cumbersome. It's hard to imagine in 2021 that we don't have a system that can electronically transfer monies between plans, which is essentially what we're building with auto portability. But those little hurdles cause people to say, well, it's easier for me to take this money. And just like you said, they pay taxes, they pay penalties. So, and then they lose the compound value of the earnings for, 30, 40, 50 years.
Yes.
Back. And that's just disastrous. If we can incubate the savings and get people to understand that preserving these savings, their financial well-being, their own internal sense of financial health improves dramatically.
Thank you, sir. My next question is for Mr. Akabas. I noted in your opening statements really a tone of optimism for many retirees or those approaching retirement age. Sometimes we feel like the entire country is on a collision course with a lack of resources in retirement. I'd love to hear from you your understanding of the state of retirement for our seniors, and then with the limited time that I have left, which will give you about a minute to answer the question, A, what is the true state of our retirement for our seniors, and B, the difference between a job and a career as it relates to the availability of retirement accounts?
Sure. Thank you, Senator Scott. In terms of the overall state, I think it is broken into two groups. One is people for whom the system is working quite well, where people have access to a retirement plan at work. They make enough income to save in that plan throughout the course of their career. They accumulate savings and have them compound over time. And then they reach retirement and Social Security supplements their income, and perhaps they have options for lifetime income. For a whole other group of people, they have very little of that, and many of that same group of people don't have the same level of financial literacy, or financial capability. And so for their retirement security, the system really isn't even there. And even if it was, they wouldn't necessarily know all the decisions to navigate the complexity that we have today. And a lot of those people are people of color, women, people who work for small businesses, temporary workers, et cetera. To answer the second part of your question, this group of people who are workers who change jobs often, and we know that workers are changing jobs more than they did a generation or two ago. We need to make sure that not only auto portability, like Spencer has been talking about, and I know that you yourself have done a lot of work on, but also making sure that those workers have plans to save in the first place, because either small businesses or the gig economy, there's much less availability. And Dr. Rees said in her testimony that many of those people, while they have access to save in an IRA, don't end up doing so. So there's a lot of holes in the retirement system that public policy can plug.
Thank you.
As I said earlier, we'll continue to update as members join us. Senator Blumenthal joined us, and as we're awaiting two senators coming up, I'll just maybe I'll get a question and then maybe turn to Senator Braun if unless we have a Democratic senator who will take the rest of my time. Dr. Scott, I wanted to turn to you regarding the importance of incentives for savings. One specific incentive for low-wage workers to save for retirement is the Savers Credit, which is a credit that we're happy is in place, but there's two basic problems with it right now. One is awareness of the credit. That's true of a lot of sometimes a lot of government programs, a lot of opportunities that people have, but it's certainly the case that the awareness is too low. And then second, the process of claiming the credit can be complicated. Earlier this year in the Recovery Act that we passed in the Senate, Democrats were proud of the fact that we had an expansion of existing tax credits, in this case 3 of them, the Earned Income Tax Credit, the Child Tax Credit, and the Child Independent Care Tax Credit. We, of course, want to extend that the benefits of those expansions in the upcoming Build Back Better legislation. But I'd ask you, because that awareness is an issue, I'd ask you, how can we expand awareness of the Savers Credit and streamline access to it?
Thank you, Chairman Casey. I think that's a great question. The Savers Credit can be incredibly impactful for certain taxpayers. I would note that there are more than one proposal in the current Congress to expand the Savers Credit and make it refundable, as well as the ability to directly deposit it into retirement accounts. And I think one of the great things about these proposals is that they have bipartisan support. So, we're looking forward to some movement there. In terms of awareness, I think this is a tricky issue, as you know. And it's not just with the Savers Credit; it's with the EITC and a host of other government incentives. That it's often getting people to be, have some knowledge about it and then how to claim them. So, I think there's probably multiple ways to do this. One is through the tax code and the Internal Revenue Service and the tax filing process. I think the IRS could be empowered to do a bit more to help eligible savers not only become aware, but help them file for it. I think, and this is another issue, though, is that you do have to currently file a tax return to claim the credit. And for many Americans who are eligible for the Savers Credit, they don't pay federal income taxes, or they don't have to. And so I think we have to think about ways of how do we sort of get them to the point and streamline that awareness so that we're actually bringing them to the table so they can take advantage of this credit. We might also think about, beyond what government can do, such as the IRS. We might think about how plan sponsors, or, I mentioned in my opening remarks, the state auto IRA programs, how they might be facilitators or almost Sherpas, helping these workers claim these credits in a way. So I think there's multiple things that we could think about, both from the public sector side, but also from the private sector side, that could help these people. But I think at the end of the day, expanding the Savers Credit, making it refundable so that it's not just an offset against tax liability, and also making sure that it gets deposited directly into retirement accounts. Those proposals in Congress that would do that would be a huge lift for a lot of working Americans out there.
Dr. Scott, thanks very much. I'll turn to Senator Braun next and then Senator Kelly. Senator Braun.
Thank you, Mr. Chair. This is an interesting discussion because as an owner of a business for 37 years prior to becoming a U.S. Senator, my wife has a business in our downtown of Jasper, Indiana, where we both grew up. I had to go through a lot of trials and tribulations, especially that all small businesses have to contend with. I mean, there's a high fatality rate to make it in terms of surviving into 5 years, let alone 10 years. And when you do finally get there, you got to remember that probably those businesses, to keep employees and keep customers, have had to do things generally right. And in the short period of time I've been here, a little under 3 years, and especially over the past 9 to 10 months, I think there's just a complete disregard for the productive side of the economy that pays all the bills of this place. And then we have to contend with the mandates that seem to be rolling out on a weekly basis. And I think a lot of what we've had to deal with, of course, was with the pandemic. I saw that businesses across the board, I visit all 92 counties in my home state, talk probably more than any senator to entrepreneurs and business owners because I'm the one most recently from there. And all I can say is here, when it comes to retirement plans, having some way to get your employees hooked up with an IRA or 401k, it's not like employers are shirking that. It comes down probably to whether they have the capability to do that and all the other things that are being asked of them currently. Like, for instance, forcing businesses that now up at 100 employees to where you either got to get a vaccine or lose your job. And that is government in overdrive, government gone wild, and it is a complete lack of respect for that productive side of our economy. I don't know when enough is enough. I think when bureaucrats in government do things, they do it with no context or perspective because most of them have never been there. And all I can tell you, I'm not talking about the U.S. Chamber of Commerce, I'm talking about maybe the National Federation of Independent Businesses. And when you take it down to 5 employees and you're willing to be that punitive to a $10 per day per worker penalty, something is out of order. And I think that as these accumulate, as we keep hitting a sector of the economy, small businesses in this fashion with what they've just come through, unless you're purposefully, intentionally trying to put even more companies out of business, it's not the time to do it, especially when I can tell you they're doing everything they can currently if it's within the realm of their capability to do these things anyway. I got a question, and I'd like Mr. Akabas to answer this. Along with what we're talking about here, along with the other mandates you've seen either looming or already issued, what does this do to the health of Main Street America? And focus on the broad maybe picture as well as this particular new directive, new mandate that we're putting on small businesses.
Well, thank you, Senator. It's good to see you again. I think you're right that we need to be mindful of the types of burdens that we are placing on small businesses who have limited resources and limited financials to manage those types of burdens. When it comes to retirement in particular, I think that there's a way to navigate this and make sure that we make it extremely simple and almost costless for businesses to comply with some type of standard that supplies their employees with an ability to save for retirement. I agree with you that having a heavy-handed requirement with lots of specific requirements that entails a lot of cost would not be appropriate. But I do think that there's a way that we know that these mandates are coming already at the state level. We can have a standard at the federal level that first makes it easier for small businesses to comply and provides them with tax credits in order to do so and simplifies the system for them. And then expect that they would provide their employees with an ability to save for retirement, because I do think that that's really important. And right now we know that so many employees at small businesses don't have that opportunity. So I fully agree with you that we need to make sure that any mandate or burden that is put on employers is taken with deep consideration and making sure that it is as costless and burdenless as possible. But we also need to balance that with the need to make sure that their employees have the opportunity to save. So I think both are important.
Thank you. I think that's a good way to look at it. Appreciate the comments.
Thank you, Senator Braun. Senator Kelly.
Thank you, Mr. Chairman, and thank you for folks that have come here to testify today. My first question here is for Dr. Rhee. So, Dr. Rhee, earlier this year, this committee looked at the impact of the COVID-19 pandemic on older workers. And something we saw then, and we're continuing to see now, is that some folks are just not returning to work. Instead, they are choosing to retire early. Now, whether that's for health and safety or trouble finding a job or other reasons, it's unclear. I'd like to get into that for a second. But, you know, Dr. Rhee, recent data suggests that as many as 3 million Americans, 3 million retired earlier than they planned due to the pandemic. And I'm interested to find out from you if you have any data on, you know, first of all, you know, why specifically, but also, you know, are we concerned, or is there a concern that these individuals risk running out of money during retirement, and is there any data on that?
Thank you. That's a really good question. So the pandemic recession was a really strange recession because it impacted different groups of workers by income in different ways. So older workers who are high income didn't see as much impacts, but the low income workers, especially low income older workers, were hit much harder in this recession than back in the 2008 Great Recession. And so for workers who are eligible for Social Security, 62 and older, who are low income, they were 20% more likely to retire last year than they were the year before. And so one thing to keep in mind is that retirement savings is really concentrated in, honestly, the top 20% of the income distribution. So if you look at the middle 20% of workers, of households by income, the median retirement savings was only $30,000 for age 55 to 64, which is negligible. And then if you look at lower income scales, it's essentially the typical household has nothing. So the big issue is that they then are claiming Social Security earlier than they should be. And again, every year that you claim early can have a 7 to 12% deduction from your base Social Security benefit, and that's for the rest of your life.
Well, thank you, Dr. Rhee. Dr. Scott, your testimony referenced retirement savings for independent contractors and gig workers, and we know they have access to retirement plans if they want them. But we've seen the benefits of automatic enrollment, and we know folks are much more likely to save if they have a little bit of a nudge or a push from their employer. So how can we make retirement plans more attractive to independent workers and freelancers, and how can we create more portable plans that people can take with them from job to job?
Thank you, Senator. It's a great question. I mean, as I mentioned in my statement, I think the demand is there despite the low levels of access amongst these non-traditional workers or contingent workers. And I think part of the issue is that there's a wide variety of these kinds of workers. We have independent contractors who work in the high-tech industry. We have day laborers. We have temp staff. And so it's very difficult to say, well, here's one solution that's going to fit all these kinds of workers who have different kinds of jobs. They work in different ways, and probably most relevant, and they get paid in different ways. Approximately, according to our survey, about 70% of non-traditional workers are paid electronically, but many others are paid by check or by cash. I remember I paid my real estate agent when I bought my house by check. So you think, well, how can we divert 5% of that check, a paper check, into an IRA? So I think it's going to probably take more than one way to get these non-traditional workers into the savings system. I think we should be thinking about, maybe it's through the tax system. Some of these workers have to file quarterly returns or estimated payments. And so maybe that's an opportunity to sort of nudge them towards saving for retirement. Perhaps it's through some of the companies that employ these workers as independent contractors. But it's very difficult to use automatic enrollment in this situation because it's not like the situation with an employee. However, there are other methods, as you said, could nudge them, or something called active choice, where you present them with the opportunity. Do you want to save part of this money that we're paying you, say 5%, or not? And that act of active choice makes people stop and consider, and then they're more likely, not as likely through automatic enrollment, but they are more likely to divert some of that money into a savings. So I think we need to be a little creative and innovative with this segment of the workforce.
All right. Thank you, Dr. Scott. And thank you, Mr. Chairman.
Thank you, Senator Kelly. Senator Lee.
Thank you, Mr. Chairman. Auto enrollment is an idea that's founded in behavioral economics and recognizes the reality that people typically make decisions based on habit and human nature. Research on auto enrollment shows that if people are signed up automatically in a savings plan with money taken out of their paychecks and then told that they can fill in a form in order to opt out, most never get around to opting out. Mr. Acabas, can you, if you could, please provide a yes or a no answer to each of the following simple questions. Does auto enrollment require that a percentage of a worker's income be automatically rerouted into a retirement savings account?
Require, well, they have the opportunity to opt out, but yes.
Okay. Is there a possibility that some workers may be unaware that their income is being redirected into a retirement savings account?
Possibility, but there are lots of forms that are provided to make sure that workers are aware of that fact.
But still a possibility. Is there a federal income tax and a 10% penalty on the amount that a worker withdraws, in addition to any relevant state income tax, if a worker decides to withdraw from a 401k account before they reach the age of 59 and a half?
Yes.
So in an auto enrollment system, could a low-income American living paycheck to paycheck be auto-enrolled in a retirement savings account, find a decrease in their biweekly paycheck, decide to opt out of auto-enrollment in order to regain the income that was being redirected, and then in an attempt to recoup the income that was redirected, be forced to pay the aforementioned penalties or fees in order to get it back?
In theory, yes. I don't know how often that happens, but yes.
Okay, so what you're telling me, what I'm hearing is that low-income Americans, those under the age of 59 and a half, who are living paycheck to paycheck, could potentially lose money due to auto-enrollment if they decide to opt out and recoup the funds that they need in order to have a roof over their head and put food on the table.
Yes, that is possible.
The financial literacy of Americans is a problem. It's an issue, and I think it's something that ought to be addressed, not only in families but in schools, in workplaces, homes, civil society, institutions of civil society. It's something we ought to focus on. But I also believe in the American people, and I think auto enrollment could end up harming the daily budgets of many low-income Americans and young families. Removing the responsibility and the opportunity from the American people to make a conscious decision to save is not necessarily going to make them more financially literate, nor will it empower them to handle the financial burdens that come with being a working citizen. We should instead seek out ways to encourage saving rather than forcing it. Now, in 2019, the Department of Labor issued a final rule that allowed for auto portability of retirement savings, meaning participants in employer-provided retirement savings accounts no longer needed to consent to have existing retirement savings of $5,000 or less transferred into a safe harbor IRA or be automatically enrolled into a new employer's retirement plan. Mr. Williams, can you tell me how can auto portability benefit families that have only a small amount that they can contribute to retirement savings account, but desire to do what they can in order to build their savings steadily over time?
Thank you, Senator, for the question. Yeah. First of all, our focus is on these very small accounts, and when you peel back the onion on the demographic, you're going to find low income is virtually synonymous with minorities and women. Okay, and so what we find, first of all, the Department of Labor ruling provided huge guardrails in terms of the notice and the affirmative notice that we have to get to folks and things like that. So there's a very long period where someone can opt out. What we've also learned through, it's not really a pilot, auto portability has been in place for about 4 years now with a particular employer, is that we actually get a 30% response rate once we let an individual know that there's 2 accounts and we can get them into their current employer plan. We get a 30% response rate of people calling us and saying, please move my money to my new employer plan. All right. So I think the job change and the education and the activity that occurs around that is just a perfect opportunity to enhance someone's financial education, explain the benefits of long-term savings. Kind of hard to explain compound interest. Even Einstein had a little trouble with that one, right? But but what a perfect time, because it's kind of Johnny on the spot in the terms of this money is available. I need to make a decision, and we have found people to be very responsible when they get a chance to keep their savings intact, but equally responsible if they have an emergency, take it. Don't get in the way of a funeral for your mom, okay? Or next month's rent check. So I think the mechanisms that the Department of Labor put in place are highly protective of individuals that need an opportunity to do something else, but also streamlines the process so that those who just want to stay in the system can do so.
Thank you very much. Thank you, Mr. Chairman. I see my time's expired.
Thank you, Senator Lee, and I want to thank the members who are with us today, as well as, of course, our witnesses for this testimony today on a critically important set of topics under the broad heading of retirement security. Just have some closing thoughts. We know that too many Americans enter retirement with either no savings or too little savings to make ends meet. The barriers that they have in front of them to achieving financial security in retirement are complex, requiring thoughtful exploration on both sides of the aisle, and I think we've heard some of that today. An important lesson from today's hearing was about our nation's retirement system is the question of who is left behind. America's low-wage workers and family caregivers, of course, are among those left behind. It's past time for Congress to act on behalf of these Americans. Reforms that benefit them are more than 40 years overdue. Congress must enact policies to help these Americans find good-paying jobs and allow them to care for their loved ones, not one or the other, both. That's why Democrats are working to pass the Build Back Better budget. Its provisions for families, for workers, for caregivers will help Americans build a more secure future. And it's why we've convened today's hearing, to explore the proposals that both Democrats and Republicans are working together on to improve access to 401k plans and other retirement accounts. I want to thank Senator Scott for his work preparing for this hearing, and I now turn to Ranking Member Scott for his closing remarks.
Mr. Chairman, let me say something off subject for a quick minute here. I will say that throughout our country, we oftentimes yearn for a bipartisan approach in government, and we so often seem to fall short on behalf of the American people. I thank you for your leadership on this committee for making this as bipartisan and, frankly, nonpartisan as possible. Many of the subjects that we talk about has nothing to do with the left or the right, Democrats or Republicans. It has to do with Americans struggling to make their ends meet, and I can't think of a better way to show the American people that we care about them more than we do of ourselves by working on their behalf and not having a political partisan conversation just because there's a microphone and a camera nearby. And so I appreciate the spirit in which we lead and frankly serve the American people. I think that retirement is a very important issue and one that too many Americans struggle with bringing those two ends together. I think there are things that we can do that will help that process for every American, because every American should be able to work hard, save for retirement, and enjoy their golden years with peace of mind. I think there are things that should be done and must be done in order to accomplish that goal. Improve retirement plan access, boost plan participation, protect auto portability, provide better lifetime income options, improve financial literacy, boost health savings accounts, simplify Social Security decisions, and promote work. By ensuring these common sense solutions and building on the success of the Bipartisan Secure Act, we can help hardworking Americans retire comfortably. Again, thank you to everyone for being here with us today. Your testimony helps us to understand and to support the golden Americans, and I yield back.
Thank you, Ranking Member Scott. And once again, I want to thank all of our witnesses for contributing their time and their expertise today. If any senators have additional questions for witnesses or statements to be added to the record, the hearing record will be open for 7 days until next Thursday, November 4. So thank you all for participating. This concludes today's hearing.
Yes, sir. Thank you.